People assume Napa's biggest wineries are just swimming in cash. The reality is some of the most well-known brands in Napa still deal with serious cash flow pressure. Today I want to walk you through how large wineries actually manage their money and how that's very different from what most people expect. I've spent years working in wine accounting, and now I run Yamas Financial, and I've seen the back end of both small producers and large established wineries. What I'm sharing today isn't theory, it's what's actually happening behind the scenes. The first big misconception is that large wineries manage by profit. They don't. Big wineries manage by cash flow and timing. Wine is one of the most cash-intensive businesses there is. Harvest requires massive upfront spending for grapes, labor, processing, barrels, long before a bottle is sold. Then that wine may sit in barrels or tanks for several years, and revenue shows up much later, especially for reserve programs. So it's very common for winery to look profitable on paper and still feel tight on cash. You can have a strong income statement and still be stressed about payroll, bottling runs, or paying growers on time. That's why the large wineries obsess over when money moves, not just how much they make. The second thing big wineries do differently is constant forecasting. They're not looking at last month's numbers and reacting. They're looking 6, 12 months ahead of time, or even years ahead of time, especially around harvest, bottling, and major purchases. They want to know, what does cash look like before harvest? What does it look like after bottling? When do we need financing, and when can we pay it down? This isn't done once a year, it's updated constantly. The third big difference is how they treat inventory. At large wineries, inventory is basically treated like cash because that's what it is. Inventory represents millions of dollars tied up in grapes, bulk wine, barrels, glass, finished cases. If inventory isn't costed correctly, everything else breaks. Margins look wrong, pricing decisions are off, and management loses visibility into what's actually profitable. Big wineries know exactly how much capital is locked up in inventory and how long it's going to stay there. Another major difference is how financials are used. For big wineries, financial statements aren't just for taxes or lenders, they're operational tools. They use them to decide when to buy grapes, when to bottle, when to slow production, and when to push sales. The numbers guides real decisions, not just compliance. Now, here's where smaller wineries usually struggle. Most small wineries focus only on the bank balance. If there's enough money in the account, things feel fine. If there's not, panic sets in. The problem is that the bank balance only shows you the past. Without rolling cash forecast, problems show up until it's too late. Inventory often isn't fully costed, so pricing decisions are made without knowing true margins, and decisions end up being reactive instead of proactive. By the time a cash issue shows up in the bank account, it's usually been building for months. The wineries that scale successfully don't guess, they plan. They understand their cash cycle, they understand their inventory, and they use their financials to make decisions early, not after the damage is already done.